get started, a quick but important reminder. Everything we discuss on this show is strictly for education and entertainment purposes. The practice investment of the day uses completely simulated trades with zero real money at risk. I am not a licensed financial advisor, this is not financial advice, and nothing here should be taken as a recommendation to buy or sell any security. Always do your own research and consult a licensed professional before putting any of your hard-earned capital to work. Markets involve risk of loss, and past performance is no guarantee of future results. Let's start with a story that perfectly illustrates why we must stay skeptical even when the headlines sound exciting. Estée Lauder has confirmed that it is in advanced discussions with a potential merger suitor, specifically the Spanish luxury goods firm Puig Brands. On the surface, this should be bullish news for a company that has been struggling with slowing sales in China and margin pressure in the high-end beauty space. Yet the stock barely moved on the announcement. That muted reaction is a textbook lesson in market skepticism versus headline optimism. When a company like Estée Lauder, a name that has historically traded at a premium multiple because of its brand strength and global reach, puts out news of a possible strategic transaction, most retail investors instinctively want to jump in. But the institutions that move the price are clearly saying, "Show me." They're looking past the rumor and focusing on execution risk, the possibility of regulatory hurdles in the highly consolidated beauty sector, and whether the premium being offered is actually compelling enough to justify the deal. This kind of show-me price action happens more often than people realize, especially in consumer discretionary names during periods of margin compression. It reminds us that the market is forward-looking and often prices in the difficulty of actually closing these transactions rather than celebrating the rumor itself. Now let's zoom out and look at how the broad markets are behaving in this environment. North American equity markets opened solidly higher today, which might feel surprising given the amount of geopolitical uncertainty still circulating. The S&P 500 is sitting at 6,581, up a respectable 1.1% on the session. The NASDAQ Composite pushed even harder, reaching 21,947 and gaining 1.4%, while here in Canada the TSX Composite has been the strongest of the bunch, hitting 31,884 and posting a solid 1.8% gain. On the surface, these are healthy moves. But when you dig a layer deeper, today's environment is a perfect case study in why we must be extremely disciplined about when we actually deploy fresh capital. Geopolitical jitters around Iran continue even after President Trump delayed planned military strikes. That lingering uncertainty has kept many institutional funds in risk reduction mode, trimming exposure rather than aggressively adding to positions. At the same time, European private sector activity has fallen to a 10-month low, with stagflation fears beginning to build across the continent. And on the other side of the world, African battery metal export curbs are putting real pressure on Chinese miners who have poured billions of dollars into developing those supply chains over the past decade. All of these cross-currents mean that while the indices are green, the underlying conviction is actually fairly fragile. This is exactly the kind of tape where emotional investors chase strength and end up buying at the wrong time. The discipline we preach on this show is about waiting for multiple factors to line up, not just a green screen. That same discipline of separating hype from reality applies far beyond merger and acquisition rumors. It's equally important when you're deciding who you trust with your money. So let's spend some time on a practical framework you can use the next time you see an M&A headline that sounds too good to be true. The framework I like to use has 3 clear filters. First, you need to evaluate the strategic fit between the two companies and, just as importantly, the size of the premium being offered. Second, you should look at the historical completion rates for similar deals in that sector. And third, you must examine whether the buyer's balance sheet and the strength of its currency can realistically support the transaction without destroying shareholder value. Today's Estée Lauder situation shows exactly why these filters matter. The market's failure to rally on the news suggests investors are assigning a high probability to execution risk and potential regulatory pushback in the beauty and personal care space. There's also the possibility that the premium being discussed simply isn't rich enough to compensate for the risks. If you want to apply this yourself, it's actually quite straightforward. Pull up the target company's last 4 quarters of revenue growth, gross margin trends, and free cash flow yield on any major brokerage screener. Whether you use Questrade, Wealthsimple, or Interactive Brokers, they all have the tools. Then compare the implied deal multiple against the buyer's own valuation multiples. This approach has historically been most effective in consumer staples and discretionary sectors during periods when companies are fighting margin compression. The key rule is simple. You only act on confirmed deals with signed agreements, never on rumors. The main risk here is time decay. These negotiations can drag on for months, tying up your capital and exposing you to opportunity cost. Knowing when not to deploy capital is just as important as knowing when to put it to work. That same patience and discipline should also guide how we interpret central bank signals and macroeconomic data. While we watch domestic policy closely, international developments continue to create ripple effects that matter for Canadian portfolios. One tool I recommend every Canadian investor get comfortable with is the Bank of Canada's quarterly Market Participants Survey, which is scheduled for release on November 9th. This survey polls actual buy-side and sell-side professionals on their expectations for Canadian GDP growth, inflation trajectories, and the future path of monetary policy. By studying the median forecasts, and more importantly the dispersion between those forecasts, you can adjust your own probability estimates for the next rate decision well before the December 9th announcement. The real edge comes when you see where professional expectations diverge from the street consensus. That divergence often creates short-term positioning opportunities in rate-sensitive TSX sectors such as financials, real estate investment trusts, and utilities. The report is available for free on the Bank of Canada website the morning it drops. There's no excuse not to read it. 2 weeks after each rate decision, the bank also publishes a summary of deliberations. Reading the exact language they use around inflation risks versus growth concerns gives you insight into how hawkish or dovish the next monetary policy report is likely to be. Compare that language against current bond yields and you can make informed adjustments to the duration of your fixed income ETF holdings inside your RRSP or TFSA. These small, repeatable steps give individual investors a genuine informational edge that used to be reserved for professionals. Let's move into a few quick hits that deserve more of that. And just a headline mention. First, the new export restrictions on key battery metals coming out of several African nations are creating real headaches for Chinese companies that have invested billions to secure those supply chains over the last 10 years. For Canadian investors who hold lithium, nickel, or cobalt names on the TSX, this shift is worth watching closely because it can meaningfully change global pricing power and project economics. Rather than making concentrated bets on single-mine developers, many of our listeners would be better served by diversified critical minerals ETFs that spread the geopolitical risk across multiple jurisdictions and commodities. Second, Greece is quietly positioning itself for a potential reclassification from emerging market to developed market status in the major index providers. If that move happens later this year, it could trigger meaningful passive inflows into European ETFs that carry Greek exposure. Both MSCI and FTSE indices would likely increase Greece's weighting, which creates a technical tailwind that disciplined investors can prepare for in advance. Third, the Federal Reserve kept policy unchanged at its latest meeting while simultaneously signaling that inflation concerns are intensifying rather than moderating. For Canadian investors, this reinforces the divergent policy paths between the Fed and the Bank of Canada. That divergence could provide some near-term support for the Canadian dollar, but it also increases volatility in any cross-border portfolios you hold. Reviewing how the Fed has reacted to oil-driven inflation spikes in the past gives us a useful historical template. Given the current tensions in the Middle East, it makes sense to stress test your energy allocations and consider options-based hedges rather than making outright directional bets on oil prices. Now let's talk about the practice investment of the day, DISCLA. IMER. This is a simulated trade for educational purposes only. No real money is involved. This is not financial advice. We continue to use a weekly hold approach on this show because it matches the lifestyle of busy professionals who don't want to be glued to the screen and helps us avoid the pattern day trader issues that can arise with more frequent trading. For today, the pick is none. After running the AI analysis across all the available data, we simply could not find a high conviction setup that meets our strict criteria. There is no single article today showing a clear earnings surprise, a confirmed takeover premium with a signed agreement, or a strong technical dislocation supported by volume. While the broad market is showing strength, up between 1.1 and 1.8% across the major indices, that strength lacks the required volume confirmation and extreme RSI readings we look for. We need to see either an RSI below 30 on a daily chart or a clear breakout above the 200-day moving average on an individual name before we get excited. Entering a position when only one factor, geopolitical relief, is present would violate our minimum confidence threshold. We keep maximum acceptable portfolio risk on any new position at 1.5%, and right now the overall confidence level on fresh ideas sits at low. Learning when not to trade is honestly one of the highest ROI skills any individual investor can develop. By requiring at least two aligned factors plus positive volume confirmation, you protect yourself from emotional fear of missing out entries that destroy long-term returns. This week, we'll continue watching the battery metals and luxury goods sectors for follow-through. If we see a clean setup with RSI below 35 combined with positive news flow, that will trigger next Monday's practice investment pick. Patience truly does compound. Our simulated portfolio currently shows no active weekly hold, which key. PS, the running total at 0 for this period. The AI system is learning from these patient stretches and adjusting its thresholds accordingly. This is all part of the learning journey that helps us separate genuine high-conviction setups from market noise. Before we wrap up, I want to share a story that hits close to home for many Canadian investors. Imagine your friend offers to manage your TFSA and you transfer $75,000 into the mutual funds and products he recommends. The orders fill, everything looks fine on the statement, but what you don't see is that your friend has an undisclosed revenue sharing agreement that pays him 0.85% annually on certain funds. Similar low-cost ETFs that would have done the same or better job paid him nothing. That 0.85% might not sound like much, but it compounds to roughly $6, $375 over 5 years on a $75,000 account, money that came directly out of your compounded return. The mechanism is called revenue sharing or trailer fees. The manufacturer of the financial product pays the advisor an ongoing percentage, which creates a clear incentive to recommend higher fee products, even when lower cost alternatives with identical or better benchmarks exist. What most retail investors don't realize is that these payments are often not clearly itemized on their statements and can continue for decades after the initial sale. That's why I always suggest asking 3 direct questions before handing over any capital. Are you a fiduciary? Do you receive any revenue sharing or trailer fees on the products you recommend? And can you show me the exact MER and compensation structure on every holding? The biggest mistake people make is assuming that friendship or familiarity removes conflicts of interest. Instead, always demand full disclosure in writing and compare the net of fees expected return against a simple low-cost ETF portfolio in the same asset classes. Protecting your capital from hidden fees is one of the easiest ways to improve your long-term performance. Before we sign off, keep an eye on any follow-through in battery metals or luxury goods names that might create a high-conviction setup for next week. That's your dose of modern investing techniques for today. Every episode is designed to make you a sharper, more disciplined investor. If you're finding value here, please subscribe, leave a review, and join us again tomorrow for the next installment of Market Intelligence. Until then, stay patient, stay disciplined, and remember, the market will always give you another opportunity if you're willing to wait for the right setup. This is Patrick in Vancouver. We'll talk soon. This podcast is curated by Patrick but generated using AI voice synthesis of my voice using ElevenLabs. The primary reason to do this is I unfortunately don't have the time to be consistent with generating all the content and wanted to focus on creating consistent and regular episodes for all the themes that I enjoy, and I hope others do as well.